What makes top traders so successful? It can be summed up in one thing, and that is win rate. So you want to make sure you have a win rate that's as high as possible, 70, 80 plus percent. That means you're going to have very few losers that you need to deal with. And as long as your wins are healthy and they outweigh your losses over time, you will be consistently profitable, and you will have a smooth P&L curve. And that's exactly what I'm going to show you how to do in this video. So the first thing is you want to find an underlying that's been beaten up pretty bad, and you want it to be around the 52-week lows. So you want it to be in and around the lowest point it's been over the past year or so. This is just going to give us a small directional bias to go long, as we are going to play the position of assuming that price is going to mean revert a little bit and move slightly higher. Although even if price doesn't move slightly higher, it doesn't matter, and I'm going to show you why in this video. So once you found an underlying that's in and around the 52-week lows, you want to make sure it has an IV rank of at least 30, and you want to make sure it doesn't have an earnings event over the next 45 days or so. And once you've got all of those things ticked off the list, you want to then pull up a list of option expiration dates for that particular underlying, because we are going to be selling options contracts. We're going to be short the contracts. This is what's going to allow us to get a very high win rate. So once you've got this list up, you want to pick an expiration date that's between 30 and 60 days out in time, and you also want it to be a monthly, not a weekly or quarterly expiration date. So there's one here, April 17th, 31 days away, and we're going to open that up. And now we are presented with the options chain. We have calls on the left, puts on the right. This orange horizontal bar shows us where the price of the underlying is with respect to the strikes. We have our expected move here, which is shown by this vertical orange bar. It's also in parentheses in the top right here, plus or minus 6.55. We have our 1 and 2 standard deviation levels shown with these dotted blue lines, and we're going to use all of this information to craft or engineer our position. So whenever you are short an options contract, that basically means you want price to stay away from that contract. You want price to stay away from that strike, and as long as it does that, you'll be able to keep all of the premium that you collect up front. So what you want to do is you want to make sure you have the delta column on your options chain. That's going to be very important. And so if we know what the expected move is, and we know that we want price to stay away from our strikes, all we need to do to get a high probability of success is simply sell contracts that land outside of our expected move, and that's going to give us a high probability of profit. But the further out you go, the higher your win rate will be, but the lower your return on capital will be. So a good medium, in my opinion, is to be between 15 and 20 deltas. So on the call side, we have a delta here of 21, so we're going to sell that at the 115 strike. And on the put side, we have a delta of 14 at the 95 strike, and we're going to sell that. And basically what we've done is we've created a range for ourselves. Okay, now if you remember, we were taking the directional assumption that price was going to revert a little bit back to its mean and basically go higher. So what we can do is we can get rid of the call side. Okay, if you thought that price was going to stay where it is, you can do the call side. If you think price is going to go down, you can if you think price is going to stay where it is, you can do both the put and the call. If you think price is going to go down, then you can do just the call side. In this instance, we think price is going to go up a little bit, so we're just going to do the put side. Okay, now in this instance here, as long as price stays above 95 or is above 95 at the point of expiration, which is in 31 days time, we will keep 100% of the premium that we collect up front, which is this number here, 78 cents. There's a contract multiplier of 100, so you would actually collect $78 up front, and this is the money that we're playing for here. Okay, $78. Now our chance of success, our probability of profit, as we can see in the bottom left, is 85%. So we've got an 85% chance of making at least 1 penny on this trade. So as you can see, we have a very high probability of success, and that's if we hold till expiration, which I personally do not do. I get out of positions at about 50% of max profit, And if we were to do that, we have a P50 here of 93%. So we're looking at a 93% chance of success on this position. And you would collect $82 up front, and our broker is going to require $2,850 of buying power. Now you might be thinking that's a very low return on capital, and it is, to be completely honest with you. This is a pretty low return on capital example. If the IV was higher, I'm sure we'd be able to get a higher return on capital. But this is just where you just need to keep going through different underlyings to see what works well. But I'm going to show you how you can reduce this buying power requirement and increase your return. So what you can do is go further out and buy another contract. So you can sell the 95, buy the 90, and what that's going to do is it's going to reduce the premium that you collect, but it's also going to reduce your buying power requirement, and this is now dropped all the way down to $457. You can make the spread a little bit wider, collect more premium, use more buying power. It's completely up to you how flexible you want to be, but this is basically what you want to do, and you want to do it over and over and over again. And let the probabilities and the odds play out in your favor. You also want to watch how much buying power you're allocating to your positions. You want to make sure that you're not being too aggressive, as long term that will not work well for you. We have created a free position sizing template. The link for this is in the description. The way it works is you just enter in the size of your portfolio. So say if it was $25,000, you can enter that. Then you enter in whatever the VIX level is. Say if it was 16.2, and then everything is going to be calculated for you. You just need to use this information. It's going to tell you exactly the maximum amount of buying power that you should be allocating to your positions. And if you would like to learn in more detail about what we do and how we do it, again, the link will be in the description. Click on EDS Premium this time and get yourself signed up. Once you're inside, you will have access to one of our portfolios, and you'll be able to see all of the actual positions that we place live, any adjustments that we make, how we manage our positions, etc. You're going to see all of it live. You can use that information to reverse engineer and study, or you can copy us. It's up to you. There's also a full course, so you don't need to have any prior knowledge. We'll teach you everything. And if you do get stuck, it's a private community, so you can just speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee as well. So if you've been through the course, followed our trades, if after 6 months you're not profitable, then we'll work with you for free until you are, or you can request a full refund. So it's completely risk-free. It's $9.99 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill, and once you've learned it, no one can take it from you, and we aim to get you to that point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.